The most famous piece of investment advice in history is also the most useless. Buy low, sell high. It's 4 words that sound so simple, but it's a mechanical task that we try to perform with emotional tools. And for the average human being, it is psychologically impossible. If it were easy, we'd all be sitting on private islands. Instead, the retail investor's track record usually looks like a buy high and sell low cycle. Today we're going to look at why your biology is actively conspiring against your bank account. We're going to talk about the brutal disconnect between price and value, and why your brain is fundamentally wired to be a terrible trader. Part 1. The market is a crowd. The first hurdle is evolutionary. For thousands of years, if you saw the rest of your tribe running in one direction, the smartest thing you could do was run with them. There was likely a predator behind them. Contrarian thinking usually meant getting eaten. Fast forward to the modern stock market. When a stock is low, it's usually because the tribe, the market, is running away from it. The headlines are grim, the charts are red, and the sentiment is toxic. To buy low at that moment requires you to stand perfectly still. While a stampede of terrified people screams that the world is ending, your amygdala, the primitive part of your brain responsible for fear, doesn't see a value opportunity. It sees a predator. It triggers a physical stress response. Buying a crashing stock feels like walking into a burning building. Conversely, when a stock is high, everyone is celebrating. The tribe is happy. Buying in at the peak feels like joining a party. It feels safe. It feels right. The market is the only mall in the world where the customers run out of the store when there's a 50% off sale. Part 2. The great confusion of price versus value. The secondary reason we fail is a cognitive failure to distinguish between price and value. They are not the same thing, though we treat them as synonyms. Price is a consensus. It's what the person next to you is willing to pay right now. It is highly volatile, driven by news cycles, interest rate whispers, and what some guy on a forum thinks is going to happen next Tuesday. Value, however, is the intrinsic worth of the business. It's cash flow, it's patents, it's machinery, it's future. The problem is that price is loud. It's a flickering red or green number that updates every second. Value is quiet. It's buried in a 10K filing that nobody wants to read. When you see a stock drop from $100 to $70, your brain interprets the price change as a value change. You think that it's 30% less valuable. But if the company is still selling the same amount of product and making the same profit, the value hasn't moved, only the perception has. Investors who buy low aren't gamblers. They're people who have developed the cynical detachment necessary to look at a $70 price tag and say, the crowd is wrong, the value is still $100. That requires a level of arrogance that most people find uncomfortable. Part 3. The pain of being wrong. Then there is the concept of loss aversion. Psychologists have proven that the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. This asymmetry creates a disposition effect. When we are low, meaning our position is in the red, we become risk-seeking in a bad way. We hold on to the loser, hoping it gets back to break even, so we don't have to admit we were wrong. Admitting you're wrong feels like a blow to your ego, and your brain will protect your ego even at the expense of your net worth. Meanwhile, when we are high, up 10%, we become risk-averse. We sell too early because we are terrified the profit will vanish. We want the hit of dopamine that comes from winning, so we cut our winners short and let our losers run. We do the exact opposite of what the math dictates. Part 4. The my baby fallacy, the endowment effect. There is a specific type of madness that occurs the moment you click buy. Psychologists call it the endowment effect. Essentially, we value things more highly simply because we own them. Imagine you're given a coffee mug. A few minutes later, someone offers to buy it from you. Statistically, you will demand a higher price to sell that mug than you would have been willing to pay to buy it 5 minutes ago. Because now, it's your mug. It has been endowed with the magic of your ownership. In trading, this is lethal. When you buy low, you aren't just buying an asset, you're adopting a pet. You start to follow the company's CEO on Twitter. You defend the company in comment sections. And you stop seeing a ticker symbol and start seeing a company that is yours. This makes selling high nearly impossible. When the price hits your target, your brain whispers, but look how well it's doing. such a great company. Why would I sell my baby now? You've moved from a rational exchange of value to an emotional bond. You forget that the stock doesn't know you own it, and it certainly doesn't love you back. To sell high, you have to be willing to kill your darlings. You have to treat every position in your portfolio like a stranger that you're willing to evict the moment they stop paying rent. Part 5. The narrative fallacy and the stories we tell ourselves. Humans are storytelling creatures. We can't look at a chart without trying to find a reason for the zigzags. This is the narrative fallacy. When a stock is low, we craft a tragedy. The industry is dying, or the CEO is incompetent. We weave a story that makes the low price feel permanent. Conversely, when a stock is high, we write an epic. We talk about paradigm shifts, new eras, and disruption. The problem is that the market doesn't care about your story. The market is just a massive centralized counting machine for human opinions. Think about the 2020 lockdowns. The story was that the world was ending. The narrative said that travel was dead forever. If you believed that story, buying airline or hotel stocks at their multi-year lows felt like lighting money on fire. The narrative made the low feel like a zero. To buy low and sell high, you have to become a literary critic of your own thoughts. You have to ask, is this a factual assessment of value, or am I just writing a screenplay in my head? Most market gurus aren't better at math than you. They're just better at ignoring the stories everyone else is telling. They look at the raw data and let the narrative die on the vine. Part 6. The solution is not a spreadsheet. So, how do we fix all this? You can't fix it by getting a faster computer or a better chart. You fix it by acknowledging that you are an irrational narrator. So, before you buy, write down the price at which you will admit the value has changed. Not the price you hope it hits, but the price where the story is dead. This is your exit. You must decide this while you're calm, because you won't be able to do it when you're panicking. And when you see a 10% drop, ask, does this change the company's ability to make money in 5 years? If the answer is no, the price is just noise. If the answer is yes, then you aren't buying low, you're buying a trap. Mechanical greed. Use limit orders. Don't trade in the heat of the moment. Set your buy orders low when the market is boring, so that when a crash happens, your computer executes the trade while you're busy being human and being afraid. Conclusion: become the rational outsider. Like we said in the beginning, buying low and selling high is a mechanical task that we try to perform with emotional tools. It's like trying to do surgery with a chainsaw. If you want to succeed, stop trying to predict the market and start trying to predict your own reactions to it. The person on the other side of your trade isn't a pro. It's someone just as scared and just as prone to FOMO as you are. The winner is simply whoever can stay rational for 5 minutes longer. We've identified the enemies. We have the herd instinct pulling us toward the crowd, loss aversion keeping us trapped in sinking ships, the endowment effect making us fall in love with our tickers, and the narrative fallacy turning math into fiction. Evolution did not design you to trade semiconductors on a smartphone. It designed you to stay alive. The secret to surviving the market is systematization. The most successful traders I know are, frankly, a bit boring. They don't have hunches. They have rules. They don't feel the market. They measure it. They treat their trading desk like a laboratory, not a casino. When you go to buy your next position, try your absolute best to actively disconnect your ego from the trade. Remind yourself that a low price isn't an insult to the company, and a high price isn't a trophy for your brilliance. They're simply points on a spectrum of human emotion. The goal isn't to be right all the time. The goal is to be rational more often than the person on the other side of the screen. The market is just a mechanism for transferring money from the impatient to the patient, and from the emotional to the analytical. It's difficult to buy low because it feels like failure, and it's difficult to sell high because it feels like leaving a party early. But if you can master those two uncomfortable feelings, you've already won 90% of the battle. Thanks for sticking around this long. Now, turn off your screen, take a breath, and go touch some grass. The chart is not the truth, value is. If you found this dive into the market's psychological basement useful, do the rational thing and hit the like button. It's the simplest way to signal to the algorithm that you value logic over hype. But don't stop here. Most traders will listen this nod in agreement and then go right back to panic selling at the first sign of red. Don't be that trader. If you're serious about mastering the mental game of finance, subscribe and join our community. We're building a library of insights designed to help you stay rational when the rest of the world is losing its mind. Remember, the crowd is loud, but the data is silent. Choose the data.